What is a quick ratio, or another name given to that is asset test ratio? If you are a student in university or you are doing a qualification in accountancy or in finance, how this quick ratio will be used in accountancy for comparing one company to other company, one company with the industry and one company with its previous or past performance. And whether you are a financial analyst, that is a great ratio for considering the liquidity position of a company, how it is compared, and what does it mean by the output of the ratio. This is what we are going to cover in this video. Stay with us till end of the video. Hi, this is Milad Akbari from Akbari Education. Welcome to your own channel. As I told you, today we are going to cover the quick ratio. What is in this video directly? The liquidity ratio explanation overall, the quick ratio, the formula of that, there will be an example, there will be practice question, and test your understanding. Directly, what is liquidity ratios? Liquidity ratios are an important class of financial metrics used to determine a debtor's ability to pay off current debt obligations without raising external capital. Overall, the liquidity ratios are here that we can compare, we can check, we can analyze, we can calculate whether the company is able to pay its short-term liabilities with the current assets of the business, whether they can meet their short-term obligations with the current available assets inside the business, or they need further external financing to support to covering their short-term obligations or not. This is the liquidity ratio, but as a part of that, we are going to discuss the quick ratio or asset test ratio. The quick ratio is an indicator of a company's short-term liquidity position and measures a company's ability to meet its short-term obligation with its most liquid assets. The only important term that you need to understand is this most liquid assets. What does it mean here? It is an indicator of a company ability to whether they are able to cover their short-term liabilities, which are within 12 months, with their current assets, which are also within the 12 months, which is expected to be convertible to cash within 12 months or no. But a bit of the area that we need to cover inside this current asset is the most liquid current assets available, which is what we are continuing to that. So whether with the most liquid current assets available, they are able to cover their short-term obligations or no. It measures a company capacity to pay its current liabilities without needing to sell inventory or obtain additional financing. So the point is here, by the term most liquid assets, we will come to that in detail, but in most liquid assets we will not consider the inventory. Why? There are companies which the inventory may not be convertible to cash very easily due to the nature or due to the situation in micro and macroeconomics or situation of the market. So the more conservative investors exclude this inventory from the calculation of this liquidity ratio, or whether the company needs additional financing to cover its short-term obligations. Let's go ahead. As I told you, it is considered a more conservative measure than the current ratio. Why? Because it includes all current assets coverage, the current liability, and current assets. There is a video, I will insert the link here. We have discussed the current assets there. In current ratio, which discuss the current asset, we are considering the total current asset in calculation of the liquidity ratio, the current asset and the current liability. But here we are excluding certain current assets which we believe are not that much easy or not the most liquid assets available in the business. That's why the most conservative investors, or those who are thinking to be conservative, they are excluding these items and will go with the quick ratio. The higher the ratio result, the better a company's liquidity and financial health. The lower the ratio, the more likely the company will struggle with paying its debt. What does it mean? If suppose the result of your calculation or the ratio reach to 1, it means that they have $1 to pay $1 of debt. If it's higher, if it's reached to 2, it means the company have $2 to pay each $1 of short-term obligations. If it reached to 0.5, it means they have 50 cents of current asset, the most liquid assets of the most liquid asset to cover its short-term obligations. So this is how we are considered. The higher the better, the lower is the weak position of the company. But however, the very high indicate that the company assets were held unused or not invested. What does it mean? If they have 3, 4, 10 ratio of the most liquid asset to 1 of the short-term obligation, it means that the company was not able to use these assets to generate more and more income. Suppose they have lots of account receivable which they were not able to collect it on time and use that for the further investment or generation of income or operations of the business. So this is a bad indicator, which is the mismanagement of the cash or working capital of the business overall. So we have let's test your understanding. This is something for you from what we have covered. Pause the video, focus on the question and answers, insert your answer in the comments below, and continue this video for the next part. Let's go ahead. The formula, let's focus fully on what items are included or how this quick ratio is going to be calculated. In a simple point, for the quick ratio, in a simple terminology, is the quick asset of the business divided by current liability of the business. What does it mean? The quick asset of the business will be divided by the current liability of the business, and whatsoever the result or the output come will be called quick ratio. But quick assets are of the business are a subset of the total current asset. It means we have the total current asset. Certain items will be considered and will be called the quick assets of the business. What are them? The cash and cash equivalents, which are very easily convertible to cash. It means even the cash equivalents are the items or certain items in the business which are even considered as equivalent to the cash because they are very easily convertible to cash or cash by itself. Marketable securities, which are depend on your position, on your country, on your location, and in the situation you are, and rules and regulations in your country, it is different also. Certain bonds, treasury bills, certain stocks or other investments, CDs and some things that the company invested and they are easily convertible back to the cash, is coming under marketable securities. Or the easy one, the account receivable. You have sold something to your customer and they are due to do the payment within 30 days. That amount will be considered as account receivable. The addition of these three will end up to the quick asset, which we are using in calculation of the quick ratio by dividing it, the quick asset of the business with the current liability. But if it is not possible to identify all of these individual asset types on the balance sheet, the total value of the quick asset can be taken from the value of current asset using this formula. It's an easier way. If the company has given certain items which does not include these three items, or it is a bit vague, you know, the inventory of the company, you know, the prepaid expense of the company, or even you know only the inventory and there was no indication of the prepaid expense, then you can use this formula to reach to the quick asset of the business. You have the total current asset of the business. Simply, the total current asset of the business, you will deduct from that the inventory of the business and prepaid expenses. Inventory, some products which are produced by the company or has been purchased to resell it back is inside the business, you will deduct it. And the prepaid expenses, there are certain expenses that you have paid in advance. And suppose you have a rent and you paid in advance for 12 months from January to December, but you are still in January. You cannot write the whole balance as expense for the January. That's why you will consider it as a current asset in the business. And during each month or each quarter, you will allocate a portion of that current asset to the income statement as expense. That's why this amount will be deducted, the inventory will be deducted and from the current asset, and you will reach to the quick assets of the business. The prepaid expense nature is somehow near to the depreciation. There is a video for the depreciation, full explanation with the example here. I will put the link here. You can go and understand the depreciation well there. Let's continue. There is an example, a very simple example, which explains this formula and the result as well. Suppose a company in the balance sheet have $150,000 of account receivable, the marketable securities, as I told, $5,000, $10,000 will be cash and cash equivalent. So overall the company have $165,000 of total current asset. And another side we have current liability. In current liability we have account payable of $125,000, $10,000 of accrued expense. What's accrued expense? Suppose you are receiving a quarterly basis your electricity bill and you are in January. You don't know what will be the total amount you are going to receive by 31st March. That's why you will write something for January, which is based on estimate of the market, based on previous months or whatsoever. When you did not receive your invoice, you will estimate something and you will record it as expense for that period based on matching principle. That's why it will be recorded as the name of accrued expense in the business, which is payable. And other short-term liability of $2,500 overall reach to $137,500. So as the formula said, that the quick assets of the business should be divided by current liability. Quick assets divided by current liability. 165,000 divided by 137,500 will end up to 1.2. What does it mean by 1.2? The company have $1.20 for each $1 of short-term obligations payable by the company. This is a clear-cut explanation with the example, and I am sure you now realize what does it mean by that ratio and how it explains the position of the company. Let's go ahead. There is a practice question. It is a bit tricky one. I recommend pause the video, think of that. After that I will go ahead with solving that. A company's quick ratio has increased from 0.9 means 0.9 to 1 at 31st December 2021 suppose, to 1.5 to 1 at 31st December 2022. Which of the following events could explain this increase? What will be the reason for this increase? We have improved inventory control, we have the refinancing of a long-term loan, we have a reduction in payables, and we have an increase in payables. Let's directly jump to each of them. A. Improved inventory control. Do we consider the inventory in quick ratio and quick assets? No, so there will be no impact. The second one, the refinancing of a long-term loan. is this related to short-term assets and short-term loan of the business? So what does it mean by long-term loan here? Is there any effect? No. A reduction in payables and an increase in payables. The 2 points which is a bit tricky. Let me explain with the formula. What we have said in calculation of the quick asset was the quick ratio was the quick asset of the business divided by current liability. So in current liability, we have the account payable or payables of the business, that this something coming here will have a very important effect in overall result of this ratio. In an example, suppose if a company have $10 of quick assets with $5 of current liability, the result of the ratio will be 2. But if the company have $10 of current asset and your liability increase, payable increase to 10, the result will decrease. Here if you can see, the result has increased. It means the vice versa. The position of the payable or liability of the company decreased. So the correct answer for our question will be C. C will be the correct answer because the payables decrease and it caused the overall result of the quick ratio increase. There is another let's test your understanding for you based on what we have studied till now. I recommend you pause the video, think of this one, answer the question in a comment below. Thank you so much for being with us till end of the video. Just a request from you that share this type of videos with your friends, those who need that, who want to understand such type of definition and explanations by considering the examples, practice questions, and the explanation given here. Again, thank you so much. I would like to invite you to like, comment, and subscribe to the channel.